It's great to be with Credit Suite again, and thanks for inviting me for, I think, the third time now. Hey everyone, I'm going to share my screen and put up our presentation. Feel free to ask questions as we go. All right, I think we're seeing this full screen now. So let's talk about growing a business and funding that business. Many small and medium-sized businesses, in our case, specifically CPG or consumer goods businesses, are growing fast. We've had a big shift to e-commerce, so a lot of products are just taking off. And what happens when you take off? You need more cash to grow faster. So there's a number of ways in which a business can face cash flow issues, and those can be, there's a lot of different avenues that you want to spend to grow that business. So allocation of resources is one where maybe you're spending on marketing, maybe you're spending on operations, maybe you're doing some in-house manufacturing or developing a new product. Could be just growing fast. You could be adding customers through Shopify, adding customers through Amazon. Maybe you just landed a new wholesale account. Let's say Target wants to put you in a few doors, and what happens next? They put you in 1,000 doors. You could have delayed payouts. We're in an environment right now where some buyers are having their own constraints, and they have to hold your payment for another 30 days, another 60 days. Net terms can be tough. Also, more recently, businesses have the businesses we work with have been buying less frequently in larger quantities to avoid potential supply chain issues that have happened. And I don't know if they're going to continue happening, but it's just sort of changed this trend to buying in larger quantities less frequently. And there's benefits to that. The benefits are you're not as reliant on the supply chain. You get quantity discounts for buying more at a time, and you have less logistics to deal with. And then, it's hard to find capital when you're an early stage, high growth businesses. You go to a bank and they say, well, congratulations on your early success. Here's either a very small amount or let's talk again in a couple of years. So what are the options? You need more money to grow faster. You got to pay for bigger inventory runs up front. How do you do it? Well, you can bootstrap if you've got money in the bank. That's certainly a great way to do it. Some folks will reach a point in time where either they're limited by cash on hand, or they no longer want to rely on cash on hand. They want to use what's available in the market, and that could be credit cards, which is generally only relied upon in the earliest stages. I would say I've talked to some business owners that went a little bit too far on credit cards, and you all probably know when you go beyond a certain threshold with your limit, you end up damaging your personal credit score, and that prevents you from accessing the best rates or accessing capital at all. So while you may have competitive rates at small scale with credit cards, it's not advised to scale that. Banks are great. Banks are the best. They have the best rates, but they're the hardest to get in with. It's usually a lengthy application process and a very rigorous approval process. So if you can get money from a bank, line of credit or a loan, it's probably going to be your lowest cost of capital. And many of our customers are working with banks and with us, which I'll get to is, one of the great selling points of Kickfurther inventory funding is that we play nice with other financing providers. Equity it's a double-edged sword. It's great to have equity investors. It's also not great to give up percentage ownership when you're going to increase your value substantially. It could end up costing you a lot more than borrowing and paying back. PO funding or PO financing and factoring, those are two traditional inventory financing methods that rely on wholesale orders. So PO financing is a great way to go if you have an order in hand from a buyer. Generally, they'll be pretty selective about who the buyer is. So it could be, Target, Whole Foods, Costco, whatever. Those are the people they'll fund with. But those rates can be high. Factoring is probably going to be a relatively competitive rate, but you don't get that capital until you've actually delivered product to your buyer. And in many cases, you needed that money months ago to put your deposit in with your supplier, or issue the payment that gets the inventory going. So that can be a tough catch-up cycle with the factoring. And it also doesn't work for e-commerce sales. So if you're selling, every transaction is a sale to a single customer on Shopify or on Amazon, you're out of luck with PO funding and factoring. MCAs, they'll pretty much work with everybody. MCAs are going to be your easiest to access, but also your highest cost. So be careful with those. They may be accessible, but that, effective rate is extremely high. Revenue-based financing, also a great solution, relatively accessible. But the way that works is, an example is Shopify Capital or Clearco. Those are revenue financing solutions. What happens is you get capital from them, and then they deduct a percentage of deposits into your account every time money comes in from sales. So, you may take on 100K from them. On day 2, you're making payments, let's say, 10, 15% of whatever comes into the account, day 2, day 3, right? Until you're paid off. And so there's a time and place for that. And it could be effective, but if you need to pay a deposit for some inventory that isn't going to be selling for 3 months, 4 months, then how can you be expected to make payments on it right away? And that's where inventory funding comes in. That's where we work. And there's also a time and place for inventory funding. And that's when, you're, as a CPG business owner, your highest cost is going to be producing the goods that you're going to be selling. And there's often a gap between when you need to pay your suppliers until when you sell that inventory and it turns back into cash. And that's, that's a good way to use inventory funding, is to pay for that inventory when your supplier payments are due, and you don't pay it back until you sell that inventory. It's also a great way to free up capital for, as we talked about before, marketing costs, logistic costs, hiring, equipment, whatever else. When you have a big cost center, you free up some capital from it. The whole business benefits from that. So Kickfurther is a great solution. We've helped over 1,000 businesses over the years. We continue to grow despite some market trends, and we offer very competitive rates. Like I said, you can go to a bank, and if they give you a line of credit or a loan, it's probably going to be at a lower cost. That's going to be the lowest cost option. And then after that, our inventory funding product is probably next in line. It's quick. We can access capital, funded in minutes. It's a true statement, but there's time associated with completing the diligence process and then the transfer of funds. But you can come to us and access capital within a couple weeks. And, we deal with CPG businesses of a variety of different sizes, anywhere from just over 400K in trailing 12-month revenue to, there is no top end limit. We've done business with companies that are 50 million in annual sales. So, and deal sizes can reflect that. Minimum is around 20K, even though we've done a little bit lower. And our average deal size is about 180K. Many of our businesses will use us multiple times throughout the year. And each one of those deals corresponds to a production run. So if you're ordering inventory, you have to make a payment to a supplier. dollar amount of that payment equals the dollar amount of the deal size. That money becomes available to pay the supplier invoice. You produce your inventory, ship it to customers, get paid by customers, and then use the proceeds of that to pay us back. If you have different product lines or different orders that are occurring at different periods in time, then you could initiate multiple deals concurrently that are overlapping with custom payment terms and minimize your cost of capital. So basically, like I said before, we work off of actual orders with your suppliers. So if you identify you have a $100,000 order, we're going to want to take a look at that order, verify its validity, and then establish sales periods off that. So, let's say you got to pay your manufacturer now. Okay, takes 2 months to produce and receive that inventory in your warehouse. And then it's going to take 2 more months for you to sell through that inventory. That is going to be a 4-month deal with payments occurring in the latter 2 months as that inventory sells. And we're actually going to have you report how many units you sold of the inventory on that order and pay based on sales. So the underlying instrument is a consignment agreement, which means we're buying inventory for you and then consigning it to you to sell on our behalf. As you sell it, use the proceeds from those sales to pay us back. In practice, that doesn't mean that we're holding inventory or interfering with your business practices in any way. It just means that we are holding title to a specific set of inventory as you sell through it, and then the proceeds from those sales are due to pay back. So that's the gist of how Kickfurther works. We'll fund the entire cost of your supplier orders, so you don't need to worry about closing a gap between what is due and what you receive. It's a good way to add new product lines and scale your sales channels. If you're relying on cash flows from your sales to be able to pay for the next production run, and you're creating a new product line, you don't have revenues that are allocated to pay for the production costs of that. If you're adding new sales channels, right, you have sales coming in from your existing sales channels that are producing revenues, but you're going to be adding a new opportunity that requires new capital upfront to produce. If you're expanding internationally, all of a sudden your product category becomes really popular. We saw a lot of that in the last few years with home goods, exercise equipment, that kind of thing. You're trying to access a lower cost of goods. That's most commonly found by increasing quantities. Buy more per unit costs becomes lower, logistics costs become lower. And you don't want to give up equity or take on expensive debt. With Kickfurther, there is no equity, and we're quite competitive on cost. And the last piece is really important. You have different solutions for different parts of your business. So you potentially have capital coming in from a bunch of providers. Those providers will sometimes butt heads. We won't be one of the ones that butt heads. We play nice, and really the security in our deals is really a specific set of inventory that we're consigning and then you're paying back on. Here's an example of a business that's worked with us for a couple of years now. Mark's the owner of Tidy Board. I've worked with him personally. They had explosive sales on Kickstarter. They make this really cool cutting board with those little washing containers. So you hang it over a sink, you chop up your food, throw it in the container, spray it clean, makes a great gift. So they've absolutely taken off after their Kickstarter campaign, and Kickstarter funds a first production run. What happens next, right? It's actually the genesis of our name is from Kickstarter. It's like Kickfurther, right? You go to the next level, next production run. So we've moved a little bit more up market now, but we're still working with businesses that are coming fresh off of that, really successful first crowdfunding campaign. The difference between us and a Kickstarter or Indiegogo is we're not working with first production runs, so we do need to see 400K in trailing 12 month sales. And also the funding is there. It's not like you need to create a video and then go find backers. There's a community of funders on Kickfurther that come to the platform every time they see a deal and participate in it. So today, anybody who's listening that's interested wants to have a meeting with us. If you create a free business account and pre-qualify and take a meeting with us, we'll send you a $50 Amazon gift card. I think that's all I've got. So Ty or Suzanne,